This is Professor at MoneyPigTrading, a former PhD drug researcher, now a data scientist and trader. Today is March 7, 2021. Today's topic is what is next in the 2021-2022 stock market, and how can the 2014 and 16 history tells us, since the macro environment was actually pretty similar between these two time frames. And the high-level summary is the energy sector XLE, finance sector XLF, and small cap IWM will outperform S&P 500 in general. So basically, this is a video, a series of video. In the last video, we actually talk about whether this market will crash like March 2020. Feel free to check it. We'll provide the link down below. So why the 2014 is so similar to like 2021? Because as we can see, actually in 2015, December 17, Federal Reserve finally raised the interest rate to 0.5% after make the interest rate to 0% from 2009 all the way to 2015 after the 2008 financial crisis. So the market has been supported by Fed with a really low interest rate. And we can see starting in 2014, the market started to become a little choppy. Like we're seeing so far in 2021, we could have big pullback, breaking the EMA support and start to push back up and down. And basically still an uptrend, but has to have several corrections, not as smooth as, like early 2013, 12. And we can see when Federal Reserve started to increase the interest rate in 2015 December, the market actually pulled back pretty hard. SPY, S&P 500 actually corrected about 15% and started to come back up again. And what happened is Federal Reserve actually raised another round of interest rate in December 2016, as we highlighted here. And actually during that time, SPY only corrected about 1.3% without not a lot of correction. And actually SPY, and then we actually highlighted several white arrows. That's where Federal Reserve actually raised the interest rate again, and actually didn't affect the market. And we actually provide the macroeconomy data during those time frames. So it's a kind of similar, like we're expecting probably late 2022, Federal Reserve probably will start to raise interest rate. So 2014 is actually very similar to 2021 in my humble opinion. So looking at the Fed SOMA data, which is how much Fed inject the liquidity to the market, and this chart is actually from 2014 to 2016. You might not be able to see very well. Sorry, to 2016. So the red one is how much Federal Reserve put in the SOMA account to support the market. The black line, the other X on the Y-X on the right, the black line is SPY price. And we can see when the Federal Reserve raised the interest rate, like I said, the Fed SPY actually pulled back 15% on December 2015. However, Fed didn't reduce the number of liquidity they inject into the stock market, and they actually can still maintaining it throughout the time frame in 2016. And that's why, in my humble opinion, even though the Federal Reserve raised the interest rate again in December 2016, even though the stock market had a pullback, but always able to come back with Federal Reserve's support. So just to give you a holistic view from 2014 to 2021, we also make the same chart on the right. And you can see the red line again is the Fed SOMA, and black is SPY price. And I highlighted again, just kind of zoom out from the figure on the left. You can see 2015 and 2016 has two interest rate increase and multiple 2017. However, that didn't really affect the stock market continuously to go up. And there was a pretty big correction in 2018, if you remember. And that's when the Fed SOMA started to reduce the account balance. Federal Reserve started to reduce the liquidity, and we can see this pretty big pullback. However, the former President Trump actually started reduce the corporate tax, I think from 28% to the current 20%, and that actually boosted the stock market quite a bit until the COVID happened, dropped back up, until Federal Reserve started to inject liquidity with the unprecedented scale, as we can see, this red line, that just boosts up the stock market. So in my humble opinion, the stock market will probably had a correction if at the end of 2022, Federal Reserve really increase in interest rate. If the inflation actually is above 2% and the employment rate drop back to normal, probably around 5%. And that time when the interest rate increased, we're probably going to see the same thing, have about 15% correction. But however, we have to watch this Fed SOMA as well. If Fed SOMA remain the same, that probably means the stock market probably won't have a really big correction. However, the other critical event we might have to see with the current Democrat government in the United States is whether they want to increase the corporate tax or not. If they do, I think it will undo a lot of this rally from 2018 to 2020 in some extent. And if the interest rate, corporate tax rate, and Fed SOMA liquidity happen all the same time, yeah, we're probably going to see a pretty big correction. But I highly doubt all this will happen at the same time as we see in 2014 and 15. So yeah, those are the events we have to monitor down the road and try to realize the timeline and everything. Just to come back to the topic about 2014 and 16, if we look at QQQ, which is the tech ETF, is actually relatively weaker and also pulled back when Federal Reserve raised interest rate in 2015. QQQ also pulled back about 15%, and the same as all the other interest rate rates, but hold it out quite a while and continue to go up from here. The other sector I want to highlight is XLF finance. We can see also when the Federal Reserve raised the interest rate, finance actually corrected 19.3%. And however, didn't have any correction as well when the Federal Reserve raised the interest rate in December 2016. But however, between the two interest rate hikes in the February 2016 and December 2016, we can see the total change of SPY, TAG, QQQ, finance, and the small cap. And we can see the finance sectors actually outperform the TAG and the SPY and also the small cap. The reason is because when the Federal Reserve raised the base interest rate, as we can proceed in the future, when the economy comes back, the bank will be able to make more money when the Federal Reserve base rate increase through mortgage or credit card debts, etc. Right? Because that's one of their major revenues. Right now, with the base base interest rate nearly around 0%, it's really hard for those banks to make money. So by having the higher interest rates, actually will benefit the finance sector and some of the small cap sector, which also have quite a bit of like industrial, finance. Industrial is basically when the economy comes back, industrial will go up, right? So definitely keep an eye out on the finance and small cap. And actually, so far this year, we're seeing small cap and finance outperform TAG and SPY in general. And I believe this trend will continue. So if you're interested in long-term investment or swing trading, then that's why MoneyPigTrading in our community, we focus so much on IWM and finance as well. And also the other thing a lot of people missed is the energy market is actually waking up in 2021. This is a totally beaten market. And now with the economy is going to reopen, you totally come back up. Right now, so far this year, the energy ETF, XLE, actually went up almost 40% and totally outperformed any other sector that we discussed in this video so far. And that's why in our retirement dollar cost average account, in MoneyPigTrading, we actually outperform the market because we put relatively heavier into the small cap and energy. And that's why so far year to date, our retirement dollar cost average account is about 7% return. Is better than SPY 4.4%. And it's a relatively conservative account. We put a lot of cash and hold a lot of like gold as a hedging as well. So that's why the performance is not as good as XLE, but we're still pretty happy with it. So the other critical question a lot of people are asking is, are tech sector dying? So based on this chart, you can see even though when the interest rate increased, the tech had a pretty big pullback, and inflation rate go up. Tech is a little choppy, but basically the tech continuously to go up. So if you're holding an asset for a longer term, the short-term noises will just be ignored, right? One of our members posted a similar chart visualization in our Discord community. And really love it, so I just want to show it. If you hold it in the short term, right, like it will be very choppy, like we have seen so far for a lot of tech names. But if you hold it long enough, it's just like a straight line, like we see in the previous slides. So if you look at 2015 and 2016, I just want to highlight tech was relatively weak and stalled, and I believe that will be the case in 2021 and 2022 so far, based on the economy outlook. But don't forget, starting in 2017, which highlighted in this arrow, all the way to 2020, tech actually went all the way up 100%. So we are still seeing a lot of stimulus on tech. Like, there will be infrastructure plans, and potentially it's going to boost up a lot of EV names, especially like tech and also green energy. All those names might have a really big boost. Not to mention a lot of high quality tech like Zoom had really decent earning per share and guidance. And with the trend now being shifted to working from home forever, a lot of this high quality tech should start to see in the longer term like a uptrend, even though short term is quite choppy and a lot of pullback. So right now, what we have to see, particularly for SPY and tech, is my personal opinion will be quite choppy this year and possibly 2022, because when the short term when economy data is good, which pretty much every week there's some economy data being reported, then the bond market will start to think that, okay, there will be inflation. So they will start to sell bonds and the 10-year treasury yield will start to go up and the tech will start to pull back. We are going to see this cycle again, just like last week. So we have to watch this Fed SOMA data closely and also watch the corporate tax related policy to see if there's an automated stock market pullback. But right now, we're just going to be choppy. In my personal opinion, the stock market is not going to collapse unless Fed pull the SOMA liquidity and or the corporate tax being increased significantly by the current White House. So what should you do? In my humble opinion, continue to hold the high quality tech names. And even though there will be some pullback, but if their solid foundation is strong, they have good fundamental, they have good technology breaking through like NVIDIA, Tesla, Zoom, all have decent cash flow, amazing technology. The other name we're going to make a video is about XL Fleet. We really like this name. I think we think this oversold, has a really good opportunity as an EV truck company. And also, if you're holding your portfolio in the long term, we highly recommend to hold some energy XLE or XLF, which is the financial sector, sorry, XLF, to diversify. And also, if you have some cash, make sure to hold some VSX, which is a volatility index, and also the 10-year treasury yield, TNX, to hedge your position. And holding longer, if you are doing swing trading, holding longer term SPY tech calls or SPY names or tech names, they're longer dated call options. And by shorter term QQQ or XLK put to hedge. And as we mentioned in the previous video, and in our Discord community, we can see when we had a really quick pullback, the QQQ and XLK put, the tech ETF put, just went up like 100, 150%, like really quickly. And that really does the hedging job. And when the stock market started to hold up, like tech and push back up, like we see on Friday, then we start to add some average down some of our long-term holding for high quality tech, and also potentially take some profit for our long-term like SPY and tech calls. And in our next market summary video, I want to highlight some reopening stocks which we really like, and also the energy stocks and finance stocks. Hopefully that can help you diversify your portfolio. So we actually have a really good long-term investment program on our Discord community with 18% average return per trade last year and 89% winning rate. Feel free to check it out. And swing trading was a really decent performance. Feel free to check it out on our website as well at MoneyPigTrading.com. Like Jim Cramer shouted our content on Twitter. Make sure to follow us on Twitter on MoneyPigTrading. And Discord community again on MoneyPigTrading.com, Twitter, YouTube, Instagram on MoneyPigTrading. The Chinese channels have a suffix with ZH. And thanks for watching and see you next time. Bye bye.